Using your accounting knowledge, fill in the blanks in the following separate income statements, A through E. Identify any negative amounts by putting them into parentheses. So let's look at the scenario for number A. So it says that they had $62,000 in sales, and then we see that they had a beginning cost of merchandise of $8,000, and then they had a total cost of merchandise purchases of $38,000. So start out with was $8,000. They purchased $38,000. So then we need to know the ending merchandise inventory. And they do tell us the cost of goods sold, so they do tell us how much they sold. So for the first one, let's see. So you'd have to work backwards. So we know that they sold 34,000. Oops. So we know they sold 34,050 is what they sold. So then if we take 38,000, okay, minus 8,000, we know that the ending merchandise inventory ending is 11,950 negative. Okay. So then from that, what we can do then is we can figure out then what the gross profit was. And so to figure that out, we take their sales, which was 62,000, minus the cost of goods sold. We know then that our gross profit comes out to 27,950. Okay, we're not done, because remember I said the gross profit, that's not your bottom line. You're worried about net profit. And again, you can think of this kind of like when you get your paycheck. It may say that you had gross income of a certain amount, but then you have net, what your actual take-home pay is, and the amount of your actual check is less because of taxes and all of that. So they had 27,950 minus their other expenses. And again, these could be rent, advertising, insurance, payroll, etc. So they had a net income of 17,950. All right. So that's for letter A. Let's look at letter B. So for this one, they're not telling you the additional merchandise purchases. So if we take that they had $16,000 of cost of goods sold, so we take that and add 3,000 to it, and then minus the 17,050. We know then that they had 1950 in total merchandise purchases, so that they had to purchase more inventory. And then from there, then what we can do is we can figure out the gross profit. So we take the amount of sales, okay, minus the cost of goods sold, comes out to 27,500 for their gross profit. Let's look at C. So on this one, what you have to figure out first is the cost of goods sold. And so in order to do that, if you take their sales and then minus their net or their gross profit, so you come out that they sold 42,250. So then if you take that plus the 9,000 minus the 7,500, that comes up that they had total merchandise purchases of 43,750. And then if you look at D, then how we can figure this out. And again, I apologize, I know I'm covering up part of the numbers here. But if you look at that, first of all, you want to know how much the cost of goods sold was. So in order to do that, we can just go ahead and add these up. So 8,000 plus 32,000, okay, minus 66 is 33,400 is the cost of goods sold. And then from that, we can figure out then how much the sales were. So they had a net income of 42,000, and then we subtract from that the cost of goods sold. And let's see. And hold up, that's not, we'd have to add. So we add back the other expenses and then the cost of goods sold. That gives us then our sales were 79,000. And then let's see, on this one, they tell you the cost of goods sold. So for E then, if you know then that they had 7,000 was the cost of goods sold, and then if you take 6,600 from that, and then the 4,560, you get negative 4,160. So that's how much the total purchases ending were, or the total inventory ending was. So then if you have that, then you can figure out the gross profit minus the cost of goods sold is 18,600. And then if you have that, then you can say, okay, 18,600 minus their other expenses of 6,000 leaves a net income of 12,600. I don't know if I gave you one like this or not. I don't think I did, but it's good for us just to review again the relationship of all of those. Exercise 5.3. So there's some different, we're going to go ahead and prepare some different journal entries, and then we're going to assume that we're using what they call the perpetual inventory system, which we say is one where we keep track of inventory as we're making sales and as we're making purchases. So let's look at the first one. It says on April the 2nd, we purchased inventory from Lion Company under the following terms. So $4,000 price, invoice dated April the 2nd, credit terms were 215 and 60, and it was FOB shipping point. So we see here that we have to go ahead and debit merchandise inventory $4,600 because we're receiving inventory and that is an asset. And then we have to credit accounts payable Lion for $4,600 because we haven't paid cash, we incurred a liability. So because of that, we have to account for that. And so again, we're going to debit the merchandise inventory, and then we're going to credit the accounts payable Lion. Now, it says on April the 3rd, we're going to pay the $300 for the shipping charges on the April 2nd purchase. So then we would go ahead and debit the merchandise inventory, and then we would credit cash because we're going to go ahead and pay cash for the freight charges. Debit merchandise inventory because that we want to show that that is part of the cost of getting the inventory. So you have a debit for merchandise inventory, and now we have a credit for cash in the amount of $300 because we've now paid cash. Now, on the 4th, April 4th, we returned to Lion Company unacceptable merchandise that had an invoice price of $600. So in this case, then, because we're going to return the merchandise to Lion, they're going to give us credit on our bill for that. And so we still haven't paid our bill to Lion, so we will debit accounts payable Lion $600, and then we will credit the merchandise inventory $600. So we debit the accounts payable Lion because we want to reduce the amount of the bill that's owed because we now no longer owe them as much as we did. and then we are going to credit merchandise inventory because we have to reduce the amount of inventory that we have by the amount that we're returning. Okay, so now on April the 17th, we sent a check for the April 2nd purchase, net of the discount and the return merchandise. So what you'll do is you will debit accounts payable line 4,000 because that now is the balance that was due. And then you will credit the merchandise inventory, the 80, which is the 2% discount because, let's see, let me look at my notes. So we purchased this, we had 15 days to pay the bill in order to receive a 2% discount. So we've done that, we've paid it within the 15 days. We had 60 days to pay it, but if we pay it within 15 days, we get a 2% discount. So the $80 is a 2% discount. So we'll credit merchandise inventory for that. And then we'll go ahead and credit cash $39.20 because that's how much we paid, that we actually paid. And then we see here with that then closes out the accounts payable line, that we now no longer owe them anything. All right. And then we're making another purchase. So on April the 18th, we purchased $8,500 of merchandise from Frist Corp on terms of 1% paying within 10 days, but we have 30 days to pay. The invoice was dated on the 18th and it's FOB destination. So in this case, you have the merchandise inventory, $8,500 because you're receiving inventory. We haven't paid cash yet. We've paid with a liability. So in order to increase the liability, we're going to credit accounts payable Frist for $8,500. So we see here now that we now have a credit for Frist, $8,500, and we now have a debit for the merchandise inventory. Now, after negotiations, we received from Frist a $500 allowance towards the $8,500. So maybe there was something wrong with the merchandise, but we can still sell it, but we can't sell it for what we had planned to. So they gave us a discount on our bill. Okay, we don't have to send anything back. So we will debit accounts payable Frist $500 because we're now trying to reduce the amount to record the amount that we now don't owe, the $500. So to correct the correct balance for that. And then we're going to go ahead and credit the merchandise inventory because we now no longer, again, to adjust the amount that we paid for our inventory, amount of inventory that we had. So we have a debit for, or excuse me, a debit for accounts payable Frist of $500, and then we have a credit for merchandise inventory of $500. And then finally, on April 28th, we sent a check to Frist paying on the April 18th purchase. So it's the net of the discount and the allowance. So we were paying it within the, I believe it was 10 days. So we're good. So now that then closes out the Frist because we don't owe them. So we would debit accounts payable Frist $8,000. That then clears out the amount that is owed to them. Then we will credit the merchandise inventory for the discount. So 1% on $8,000 is $160. And then we'll go ahead and credit cash $78.40 because that is the amount of cash that we're actually paying. And then we can go ahead and total these up. So we see here that merchandise inventory, we now have a balance of $12,060. And then the cash that we've paid out now is $12,060. So the first example there, what we were doing was we were doing purchases. So that's when our company, we purchased merchandise that then we're going to resell. So now this one that we're going to go over right now is when we're making sales. So now we're a business, we're on the other side of the transaction. So on May the 3rd, Allied made its first and only purchase of inventory for the period of May the 3rd for 2,000 units at a price of $10 cash per unit. So the total purchase we're discussing is $20,000. So you could say we had merchandise inventory, and then we could say 2,000 units at $10. So we have a debit of merchandise inventory for $20,000 because we're now increasing our merchandise inventory, which is an asset. And then we will credit cash for $20,000 because we've paid cash for that. So in order to decrease the asset, which is cash, we have to credit. So let's look at the 5th. So May the 5th, Allied sold $1,500 of, or excuse me, not dollars, 1,500 of the units in inventory for $14 per unit. So the invoice total was $21,000 to Macy Company. But again, that's on credit terms of 210 and 60. And so the goods cost $15,000 to Allied. So there's two portions to this that we're going to record. So the first one, okay. So the first portion of this that we're going to record is the actual sale. So you have accounts receivable of $21,000 because we haven't actually received the cash yet from Macy, okay, or from Massey, okay? And then you have sales then of $21,000, and that records the revenue. Then you have to record the cost of goods that were sold. So you have cost of goods sold, which is $15,000, because again, these units, they cost us $10 a piece. So $15,000 cost of goods sold. And then you have merchandise inventory, a credit of $15,000 because that reduces the amount of inventory that we have. And then on the 7th, Massey returns 125 units because they didn't fit the customer's needs. So the amount then that they're returning is $1,750. And Allied restores the units, which cost $1,250 to its inventory. So they're gonna, Massey returns these, and so $1,750 is the cost, is what they owed for them. The $1,250 is what Allied actually had paid for them, and they are going to go ahead and return them to inventory. So you have a debit for sales returns and allowances of $1,750, and then you'll credit accounts receivable for $1,750. So you're accounting for the fact that you made this return, which is to sales returns and allowances. And remember that sales returns and allowances is a contra account to your sales. So you'll debit that, and then you'll credit the accounts receivable again to reduce the amount that you expect that you'll collect. And then you'll go ahead and add those back to your inventory. So merchandise inventory, so 125 units at $10 a piece is $1,250. So you'll debit merchandise inventory, and you'll credit the cost of goods sold now, $1,250. Because you haven't sold them, you're now getting them back. So to reverse that out, you'll credit the cost of goods sold. All right. So now Massey discovers that 200 of the units are scuffed, but are still of use, and therefore keeps the units. So they realize that it was damaged, but they're still usable. But they can't sell them for what they thought that they could. Okay, so Allied gives a price reduction or allowance and credits Massey accounts receivable for $300 to compensate for the damage. So we have to record that. Okay, so we see here then that we would debit sales returns and allowances for $300 because that's the amount that we're taking off their bill, and then we'll debit the accounts excuse me, credit the accounts receivable. So we'll debit sales returns and allowances, credit accounts receivable 300, because now you're going to take that off what you expect to receive and off their bill. And then on the 15th, Allied receives payment from Massey for the amount that was owed on the May 5th purchase. Payment is net of returns, allowances, and cash discounts. So then what you'll do is you'll go ahead and debit cash. You'll debit cash for $18,578 because that's how much cash you're receiving. And then you're giving them a sales discount because they're paying you in time to receive that discount of $379. And then it was a 2% discount for, what did I say? 210 net 60. So they had 6 days to pay, but they had a 2% discount if they paid within 10 days, and they did. They paid on the 10th day, so they barely made it. So you have that. So you debit the cash, debit the accounts receivable, or excuse me, debit cash, debit the sales discount, and then you'll credit the accounts receivable then the full amount of their bill because they're satisfying their bill. We can do one more. So this is another one about recording purchases, returns, and allowances. We're preparing journal entries to record the following for Massey, which is the buyer. Okay, that makes sense then. I'm sorry. So in this case then on number 8, then what you're doing is you will debit the accounts payable, and because that reduces the amount that Massey owes Allied. I'm sorry, I read this wrong. I'm thinking, okay, what? And then you'll credit the merchandise inventory because that because you're taking those things out of Massey's inventory because now they don't have it because they're sending those back to Allied. And then number 15 is Allied receives payment from Massey for the amount owed. So then you would have accounts payable debit of $18,950 because that closes out then the amount that Massey owes. They're paying their bill for what was returned, what they still have, and for the discount that they received for the scuffed product. And then you have to credit the merchandise inventory $379. That accounts for the discount because they're paying within the discount period. And then you'll credit cash $18,571 because that's the amount of cash that is being paid. And this one we're going to end up doing both sides of this. So Santa Fe Retailing purchased merchandise as is, so with no return. So they're not able to return the merchandise from Misa wholesalers with credit terms of $310 net 30. So 3% discount if it's paid within 10 days, but they have 60 days to pay. And the invoice total of $24,000. The merchandise had cost Misa $16,000, assuming that both the buyer and seller use the perpetual system and the gross method. So the first thing we're going to do is we're going to go ahead and prepare the entries for the buyer side, which is the Santa Fe Retailing. What would happen for them as the buyer? So for them, they're going to debit the merchandise inventory $24,000 because for Santa Fe Retailing, they're purchasing it. Their inventory is going to go up. So inventory is an asset. So to increase an asset, you're going to debit. And then you're going to credit the accounts payable $24,000 because Santa Fe Retailing has now created a liability for them. Okay, so we credit that in order to increase it. So now, if they pay the bill off within 10 days, they're going to be able. Santa Fe Retailing is going to be able to take a 3% discount. So you'll have accounts payable debit for $24,000 because now that's going to make it now 0. And then you have merchandise inventory credit for $720. 720 is a 3% discount. And then we're going to then go ahead and pay cash then for the remaining, which is 23,280. Now, if for some reason they miss that cutoff of 10 days, they still have to pay it within 60. So if they do that, then you would just debit the accounts payable, because that clears that out, and then they'd have to pay cash 24,000. Okay. Now we're going to kind of switch places now and think about on MISA what kind of things, how they would have to record. So for them, they're going to have, for MISA wholesalers, they're going to have an accounts receivable from Santa Fe Retailing of 24,000. And then they now have sales revenue of 24,000, which is a credit. And then they also have to record the cost of goods, what it cost them. So they're going to debit the cost of goods sold, 16,000, and then they're going to credit the merchandise inventory, 16,000. So the cost of goods sold is a contra account to sales. So we're in a kind of like an expense account. So we'll do that. And then the merchandise inventory, 16,000, because we're reducing the amount of inventory that we're holding. So now if Santa Fe Retailing pays their bill within 10 days, they're going to qualify for a discount. So, and I'll just bring this up. So you're going to receive cash in the amount of 23,280. So you'll debit cash in that amount. You'll also debit the sales discount of 720. Okay. Because you have to account for the amount of discount that you're giving. And then you will credit the accounts receivable the full amount of 24,000, because now Santa Fe Retailing, they held up their end of the bargaining, so now they don't, their balance, owing balance now is zero. Now if they pay after the 10 days, then they don't qualify for the discount any longer, so they have to pay the full amount. So then MISA wholesalers would receive cash in the amount of $24,000. That would be a debit, and then we would just credit the accounts receivable 24,000. So this is another one of these, again, kind of a similar thing, but we'll just go ahead and go over it again just for more practice. So Sydney Retailing buyers and Troy wholesalers, the sellers, enter into the following transactions. Now both Sydney and Troy use the perpetual inventory system and the gross method. So on May the 11th, Sydney accepts delivery of $40,000 of merchandise that it purchases from resale from Troy. And so the terms of that are 3% discount if it's paid within 10 days, is what that means, 310. And then N90 means that they have 90 days. And an FOB shipping point, that means that they have to pay for the shipping. Okay, if it's FOB destination, that means that the seller is the one that would pay the freight, but because it's FOB shipping point, that means that the buyer is the one that has to pay the shipping cost. And so the goods cost Troy $30,000. Sydney pays $345 cash to express shipping for the delivery charges of the goods. So let's look at this first part. So the first part is, and again, we're talking about Sydney Retailing, which is the buyer. So for them, they would debit merchandise inventory 40,000 because we're increasing on their inventory, and then they would credit the accounts receivable 40,000 because, excuse me, accounts payable 40,000 because they have a liability. Okay, and then so we took care of that. So that's the amount for the merchandise. That's the first part. The next part is the shipping. So you're going to debit merchandise inventory, $345, because you have to account for the cost of the shipping and the cost of your merchandise. And then you'll go ahead and credit cash, $345, because we actually went ahead and paid cash to the freight company, which in this case, the freight company was Express Shipping. All right, so on the 12th, Sydney returns $1,400 of the $40,000 of goods to Troy, who receives them the same day and restores them to its inventory. The return goods had cost Troy $1,050, and I don't think right now we're not worried about how much it costs Troy. We'll be worried about that later. But for right now, what we'll do is we're going to debit our accounts payable $1,400 because that reduces the amount that we owe. We now don't owe Troy as much. And then we're going to credit our merchandise inventory $1,400 because now we don't have as much inventory now because we've now sent some of that back. So now on the 20th, Sydney pays Troy the amount that was owed. Troy receives the cash immediately. So you have accounts payable in the amount of $38,600 because that's now the remaining balance that was due. And then that's a debit, and then credit for the merchandise inventory, $1,158, because $1,158, that is the discount that is taken because we're paying it within 10 days. And then we have cash credit $37,442 because that now is what we're actually paying. So now we're kind of flipping sides. So now we're thinking about now, before this is as the buyer. So Sydney's the buyer. So now we're going to talk about Troy, which is the wholesaler. Okay. So on the 11th, we said that Sydney accepts delivery of $40,000 of merchandise it purchases for resale from Troy. And again, the goods cost Troy $30,000. So Troy has an accounts receivable debit of $40,000 because again, that is an asset because they haven't been paid yet, but they're expecting. So we'll debit accounts receivable $40,000 and we'll credit for sales $40,000 because we're recording the sales revenue. Also on the 11th, we have to record the cost of the goods that we sold. So we have cost of goods sold debit for $30,000 because it actually cost us $30,000 for the merchandise. We sold it for $40,000, but it cost us $30,000. So we'll debit that cost of goods sold, and then we have merchandise inventory $30,000 because we're now taking those things out of inventory because we're now sending them to Sydney. So now on the 12th, Sydney returns $1,400 of the goods, and the return goods cost Troy $1,050. So you have sales returns and allowances of $1,400, and you have the accounts receivable of $1,400. So you debit sales returns and allowances to record the amount of the return, which again, that is a contra account to sales. And then you have, because remember, sales normal balance is credit, but sales returns and allowances normal balance would be to debit. And then you'll credit the accounts receivable $1,400 because now you're not going to receive the amount that because they don't owe it. And then you'll go ahead and add that back to your inventory. So you're going to debit your inventory $1,050 because you're adding those back to the inventory, and then you will credit the cost of goods sold $1,050 because you're taking that out of what you sold now. You're just reversing it. So then on May the 20th, Sydney goes ahead and pays Troy the amount that was due. So Troy will debit $37,442 because that's the amount of cash that Troy received. They also will debit sales discounts $1,158 because that is the amount of the balance that Sydney had times 3%. Okay. And then you will credit the accounts receivable $38,600 because they now have Sydney's now satisfied the bill. Okay, so this is something, it's similar, but we're going to go ahead and set up our T accounts. And it kind of help us again to kind of understand the relationship of how these things work. So the following listing summarizes Tesla's company's merchandising activities for the year. Set up T accounts for merchandise, inventory, cost of goods sold. Enter the summarized activities into two accounts and compute the T account balances. So we see here that we have a merchandise inventory account, debit and credit, and cost of goods sold, debit and credit. So the first one is the cost of merchandise that was sold to our customers. And so that's 196,000. So we're going to put that on the credit side because ordinarily, if we're a business, we are adding to our inventory. Inventory is an asset, so we would normally debit it. But in this case, we're now taking that out of our inventory because we're selling it. So we will credit. And then we have cost of goods sold, 196,000, okay, debit. Because we have to debit, it's kind of like an expense. So in order to increase an expense, we debit. And so, and then they told us that the balance at the beginning of the year was $25,000. And then you have an invoice cost of purchases, 192,500. So you've adding, so you started off with 25,000, but then you purchased more inventory in the amount of 192,500. Now you had shrinkage of merchandise at the end of the year. So again, it could be, as I talked about in the lecture, it could have been a 5-finger discount. It could have been that maybe we didn't receive maybe the amount of merchandise that we thought that we did. It didn't get put up. Maybe some of it somehow got cut. Maybe when they opened up the carton, maybe it got cut. So there's different things. So they had shrinkage in the amount of $800. And so you will credit the merchandise inventory in order to take account for the amount of shrinkage that we had. And then we'll go ahead and debit our cost of goods sold for $800. Now we didn't sell the merchandise, but again, it's an expense. So we have to record that, how much shrinkage we had. And then we had the cost of transportation in for merchandise purchases. That's $2,900. So we will debit the merchandise inventory for that, because again, that we have to account for the cost of that. Then we had returns by customers of $2,100. So we're adding that back to our inventory because we're going to sell that then to someone else. And then we had returns by customers. So you'll have to go ahead then and credit the cost of goods sold because you now no longer sold those items and you're adding them back to your inventory. So in order for everything to be right, you'll credit the cost of goods sold. And then you have a discount received from suppliers on merchandise purchases. So that's $1,700. So you have to make everything agree in the merchandise inventory account. So the inventory didn't cost you what you originally put. It cost you a little bit less. So we credit in order to reduce the cost of our inventory. And then we have returns to and allowances from suppliers on merchandise purchases. So we returned some of it, or maybe some of it was damaged. They gave us a discount of $4,000. So you have to keep track of that. So then we have to figure out our balance. And so what we can do then is if we add up all of our debits, okay, minus our credits, that's going to equal our balance. And we know that for merchandise inventory, we know that it should have a normal debit balance because it's an asset. Okay, and then we can do the same thing for our cost of goods sold. Okay, so again, add up all the debits, subtract the credits, and we know then that our cost of goods sold balance is 194,700. And again, its normal side is a debit because it is part of our income statement, and it is kind of like an expense account. So we're going to prepare the journal entries for the merchandising transactions of the dollar store, assuming it uses a perpetual inventory system and the gross method. So the first one is, okay, the first transaction is the dollar store purchases merchandise for $1,500 on terms of 25N30 FOB shipping point. Okay. So So we have merchandise inventory in the amount debit in the amount of 1,500 because the dollar store is purchasing inventory. So we're going to increase their inventory in the amount of that. And then we haven't paid the bill yet. So we're going to have to credit our accounts payable 1,500 because that is increasing the liability. Now on the 5th, they're going to go ahead and pay for the November the 1st purchase. Because it's still within the 5 days, they're able to take a 2% discount. So we're going to then go ahead and be able to debit accounts payable $1,500 because that now clears up the balance that we owe to our vendor. And then we're able to take a 2% discount. And so that would be $30. So we'll credit the merchandise inventory for that. And then we'll go ahead and credit cash for $1,470 because that's what we actually paid. Now, November the 7th, Dollar Store discovers and returns $200 of defective merchandise purchased on November the 1st and paid for on November the 5th for a cash discount. So they receive cash, and again, minus the discount. They're not going to receive cash for the beginning total of what it was. They're going to receive cash for 98% because they already got a 2% discount on it. So they receive cash in the amount of $196, and so debit, and then they're going to credit the merchandise inventory $196 because that now is what they're sending back. And then on November the 10th, Dollar Store pays $90 cash for transportation cost of the purchase. So you have merchandise inventory, you're going to debit that 90, and then you're going to credit the cash 90. Okay, so now on November the 13th, Dollar Store sells the merchandise for $1,600 on terms of net 30. The cost of the merchandise is $800. So Dollar Store is going to have an accounts receivable debit in the amount of $1,600 because that's what they expect that they will receive. And they're going to credit sales in the amount of $1,600 because they have to record the revenue. Okay. And then the merchandise is returned to the Dollar Store from the November the 13th transaction. The returned merchandise are priced at $160, cost $80. The items were not damaged and they were returned to inventory. So you have cost of goods sold of $800 because that's what it cost us. Debit, because we're going to go ahead and reverse that out, and then you're going to credit merchandise inventory for $800. Because again, you're taking those out of inventory. Okay, on the third, okay, I'm sorry, I guess I'm skipping. Oh, I see what I did. So the first part there, the first part of this is to record the sale, excuse me, and the second part here is to record the cost of the sale. So cost of goods sold 800, merchandise inventory 800. Okay, so that's for the 13th. So you have two transactions. Now on the 16th, you have sales returns and allowances 160 debit, and then you have a credit for accounts receivable for 160 because now because returns and allowances because you're giving them that, and then your customer that, and then you have to credit the accounts receivable in order to reduce the amount of the asset. And so you're going to go ahead and add them back to your inventory. So it cost you $80. So debit merchandise inventory and then credit the cost of goods sold. The ones we've been doing so far have been dealing with a perpetual inventory system, which is kind of like what most retailers, your Walmart, your Save Mart, your Target, any of those types of stores, they use what's called a perpetual system. So as merchandise comes in, it's recorded on computer, and then when it leaves, it's recorded on computer. The other ones here, 15 and 515, 516, and then 518, those are dealing with what's called a periodic. And so an example of a periodic I talked about was it's when a business, they don't maybe use the computer for doing their inventory. So I talked about here where I live, we have a store called Winton Hardware, and basically their cash register, their POS system is basically an overglorified adding machine. Okay, everything has a little sales tag on it that they use. So they actually have to physically go in and physically count their inventory. So they use what's called a periodic system, and they may do that every quarter. They may do that maybe every month, et cetera, to either figure out then what's sold and also then to be able to figure out maybe if they had any kind of shrinkage, adjusting and closing entries for a merchandiser. The following list includes selected permanent accounts and all of the temporary accounts from the December 31st unadjusted trial balance of Emiko Corporation or Company. That's a company that's owned by Kumi Emiko. Emiko Company uses a perpetual inventory system. As I said, so that means that they keep track of their inventory as it comes in and as it goes out, okay? Usually through a point of sale or POS system, okay? Computer system. Use these account balances along with the additional information to journalize, first of all, the adjusting entries and then B, the closing entries. The first thing that we're going to do is we have some expenses. So we have accrued and unpaid sales salaries in the amount of $1,700. And so we've dealt with this before in the previous chapter. So what we'll do now is you will go ahead and debit the sales salaries expense in the amount of $1,700, and then you will credit the sales salaries payable in the amount of $1,700. And so again, you're going to debit the expense because you have to add to the expense because we're closing out our books now. So we have to add that into our expenses for our income statement. But then we're going to credit the sales salaries payable because that creates a liability for us because we have to pay that, and we'll pay that at a later time. And then you have prepaid selling expenses of $3,000 have expired. So you will go ahead and debit the selling expenses $3,000, and then you'll credit the prepaid selling expenses $3,000. So again, you're adding to your expenses debit, and then you will, in this case, we will credit the prepaid selling expenses because prepaid selling expenses is an asset, similar to how when we talked about prepaid insurance that it's an asset. But now that we've used it now, we go ahead and credit it to show that. And then we have the cost of goods sold. And so we've determined that to be $1,300. So you have the cost of goods sold $1,300 and then merchandise inventory $1,300. And that is to go ahead and adjust for the shrinkage that took place. So cost of goods sold, it's a contra account to your sales. So it acts like an expense. So 13,000, and then you're going to credit your merchandise inventory because you're bringing your inventory down now to show the amount of shrinkage that took place. Because you see here that the merchandise inventory to start out with was 30,000, and then we show that we really only had 28,700. Now we're going to go ahead and adjust our trial balance. So we have a debit for our salaries expense. We have a debit for our selling expense. We have a credit for our prepaid selling expense, and then we have a debit for our cost of goods sold, and then a credit for our prepaid merchandise inventory, the amount that was used. So if we subtract from 30,000, we subtract 1,300, we get that we should have a debit balance of 28,700 for our merchandise inventory. Same thing here, prepaid selling expenses started out at 5,600, we've used 3,000, so subtract. We now have 2,600 of prepaid selling expenses. And then we could just go ahead and carry over the withdrawals and carry over the amount of sales that we had, and then returns and allowances, sales discount. Now here what we got to do is the cost of goods sold. We have originally $212,000. What we have to add, since it's a debit, we're going to add, and so we're going to add 1,300 to it because somewhere along the way we lost some of our inventory. So now we have cost of goods sold of 213,300. Then you have same thing here, sales salaries 48,000, but then you're adding the 1,700 to it. Comes out to 49,700 for the sales salary expenses. Or utilities are the same. We just carry it over. Selling expenses, you're adding 3,236, so now it's 39,000, and then the administrative expenses you just carry over. So we now have done our adjusted entries. So now what we can do is we can go ahead now and figure out our closing entries. So then we're going to go ahead and close out sales. So originally, remember that we credited sales. So in order to close it out and make it zero, because we're getting ready then for the new year, since we originally credited it, we will debit sales in the amount of 529,000, and then we will use our garbage bag, our income summary account, and we will credit that $529,000. So then the next thing is the sales returns and allowances. We need to make that zero. So because originally that was a debit, so we will credit income summary. Or actually, we're going to close out all of our accounts. So sales returns and allowances 17,500, and then we have sales discount of 5,000, cost of goods sold 213,000. Okay. So we have list all of our expenses. So we list all of them here. So we have sales returns and allowances, sales discount, cost of goods sold, sales salaries and expense, utilities expense, selling expense, and administrative expense. We list all those out. So then we're going, and again, those were all originally debits, so we're going to credit them in order to make them zero. And then the total for income summary for our expenses is 444,500. So then what we're going to do is go ahead and add the gross profit to the K Kamiko capital. So you're going to debit the income summary 84,500, which closes out the amount that is in our income summary, because that is the difference between this number and this number. So that's how much is in our income summary now, but we want to make that zero. So we're going to, since it had a positive credit balance, so in order to clear it out, we're going to debit, and then we'll credit K Kamiko Capital 84,500, because now we're going to add that to her capital. The next thing we have to do is take care of her withdrawals because she withdrew money, so we have to reduce that from her capital balance. And so to do that, we will debit $33,000, and then we will go ahead and credit the K Kamiko withdrawals $33,000, because that's then going to go ahead and wipe that out. So the next one is the net sales for multi-step income statements. So a company reports the sales, the following sales related information. They had gross sales of $200,000, sales discounts of $4,000, sales returns and allowances of $16,000, sales salaries expense of $10,000. So we're going to prepare the net sales portion of the multi-step income statement. So we said that they had sales of $200,000 less the sales discounts, which is $4,000, less the returns and allowances of $16,000. So that's going to give you a total then for our deductions, or our deductions are contra to sales of $20,000. So then we had net sales then of $180,000, because you take $200,000 minus 20, that's going to give you $180,000. Okay, so this one is computing your acid test ratios. So we're going to compute the current ratio and the acid test ratio for each of the following separate cases. Round ratios to 2 decimal places. Which company case is in the best position to meet short-term obligations? So you take the total current assets and then divide them by the current liabilities. So if we take for Camaro, so we have 5,200 and then divide by 2,200. You get that the current ratio is going to be 2.36. So they said it 2 places, so it'd be 2.36. Now, just make sure we're clear on our rounding. Let's say that this 3 was a 5 or higher. If it was, then it would be 3.7. But because it's a 3, we just drop it. And then GTO, we see had 3,500 of current assets and then 1,200 of current liabilities. And actually, so again, remember current assets, those are things like your cash, your short-term investments, your current receivables, and your inventory, and your prepaid expenses. So that's your total current assets, okay? So that's how that's computed. So this one would be 2.92, because again, this last number here is a 5 or higher, so that would be a 2. So 2.92. And then Torino would be 1.95. And then we can do our acid test ratio, which is the total quick assets divided by current liabilities. And so, so your quick assets then would be things like your cash, your short-term investments, and your current receivables. So that means that that's what you could turn around quickly in order to get money than to pay your liabilities. So it should be 1.07. Okay. So then the next one for GTO, if we look, is 700 divided by is going to be 0.58. And then for Torino, it's going to be 0.4. 0.61. So now the question then that they ask is, which company's case is in the best position to meet their short-term obligations? And so would any of you like to take a stab at that?
Would it be Camaro?
Mm-hmm. Absolutely. Yeah, it would be Camaro. Why would it be Camaro?
Their acid test ratio was higher.
The acid test ratio is higher, yeah. Because again, and the reason for that would be because, again, it's the things that they could turn around a lot quicker in order to pay, right? Your inventory, they're going to have to sit on that for a while, right? And their prepaid expenses, you can't get that money back very quickly, right? So the part of this that they're mainly concerned about then would be the things that they could turn around a lot faster. And so you see here that then for the quick assets, they have the highest, but they also then for the liabilities, but then the ratio is a lot higher. It's 1. It's more than 1. But we see here, GTO, they don't have enough, and then Torino even, they don't have enough either. So it's important, again, to use that to kind of monitor, to kind of think about, do you have enough assets that you could turn around in order to meet your current liabilities if you needed to? So this one's going to be doing a income statement, multi-step. All right, so Fit for Life Foods reports the following income statement accounts for the year ended December 31st. Categorize the following accounts, again, as selling expense, as sales staff wages, rent expense, selling space, TV advertising expense, sales commission expenses. Categorize remaining expenses as general and administrative. So the first thing that we would start with is our sales. Our sales were $220,000, and then we have to reduce then our contra accounts. So we have sales discounts of 16, and we have sales returns and allowances of 4,000. So then that the total for that would be 20,000. So our net sales is 200,000. Then we have the cost of goods sold of 90,000, and that is the cost of our merchandise. So then we have a gross profit of 110,000, and then we list out our expenses. And again, we're going to categorize them into either selling expenses and then general and administrative. So our selling expenses then are our sales staff wages, which is 23,000, our rent expense, and it's the portion of it that is our selling space. So for example, if you think about a store, let's say Target, you know that they have the main sales floor, and that's the part when you walk in, you see all the merchandise on display. Well, you know that they have a big area in the back that you have, as a customer, have no business in, and that is all of that's not selling space, that's more that, or maybe there's part of it where there's office space and there's a break room and there's where the security people are at and all of that. That's not part of the selling expense, that's part of the general and administrative, okay? But this rent expense for the selling portion of it is 10,000. TV advertising expense is 2,000, and then they also pay sales commission to their employees of 13. So total selling expenses is 48,000, and then they have some general and administrative. So they have their office supplies expense of 700. They have insurance of 1,300. They have depreciation expense on the office copier of 500. And then they have office salaries expense of 32,500. And so the total then for the general and administrative expense is $35,000. So the total operating expenses then are 83,000. And so then if you take, so 110 subtract 83, so you have income from operations then of 27,000. Okay, so then you have some income from some other sources. So you have gain on sale of equipment of $6,250, because that's not, our business isn't selling equipment, but maybe there was some, maybe they sold some retail fixtures, or they sold maybe some computers or something. That's not their main business that they're in, but they sold that and they made, had a gain on that. Then they had some interest revenue from money that they had in their bank of $750. So then the total other revenue gains is $7,000. So then their total net income then was $34,000. This one is, again, so what we've been talking about is so far has been the perpetual method of doing inventory. Now we're talking about how you would do it if you were using the periodic method. So let's talk about that. All right, so we're going to prepare the journal entries for the following transactions for a retail store. Assume a periodic inventory system and the gross method. So remember that for the periodic system, you're going to have your purchases plus the transportation in, and you'll subtract the purchases, returns, and allowances, and you'll subtract your purchase discount. So the cost of goods sold is calculated at the end of the period based on a physical count. So remember, again, as I say, you're going to have to physically go in and count. It's an example of my hardware store with the little stickers that are on all of the products. Okay, they don't actually use the computer. So the first thing is on April the 2nd, they purchased $4,600 of merchandise from Lion Company with credit terms of 215 and 60. And then again, the invoice was dated on April the 2nd, and it's FOB shipping point. So we had purchases in the amount of 4,600. So we have a debit, and then we have to credit the accounts payable Lion 4,600. Now, one thing to note here, purchases is different than what we would ordinarily use. We normally would use merchandise inventory, but in this case, you're going to use purchases. Okay, good. So they're showing you here. So this is the periodic system, and then this is the perpetual system. So we use purchases over here for a periodic system, but in a perpetual system, it's merchandise inventory. Okay, the next one is also on the 3rd, is that we paid $300 cash for shipping charges on the April 2nd purchase. So for the perpetual system, you have transportation in of $300, debit, and then you have a credit for cash. Now, if you're using a perpetual system, you're going to charge that to the merchandise inventory. So debit merchandise inventory for $300, and then you'll credit cash for $300 because you're paying out cash. The next one is on the 4th, is you returned to Lion Company unacceptable merchandise that had an invoice price of $600. So you will debit the accounts payable Lion 600 because you have to reduce the amount of the liability there. Now you'll credit purchase returns and allowances for $600. Okay, that's in a periodic. Now in a perpetual, you'll still debit the accounts payable Lion because you have to reduce the amount of the liability, but you will then credit the merchandise inventory account for the amount of merchandise that you're returning. Now on the 17th, you sent a check to Lion Company for the April the 2nd purchase, net of discount and the returned merchandise. So you will debit the accounts payable account 4,000 because that now is what Lion was owed, but you have a purchases discount of $80 because you're taking off the 2% because you're paying it within the 15 days. And then you are actually, so you credit that, and then you'll credit cash $39.20 because you're paying cash. Now, for a perpetual system, what you would do is you would go ahead and debit, same thing, debit the accounts payable, 4,000 to clear that out. Instead of crediting purchases discounts, you'll credit merchandise inventory for 80, and then you will go ahead and credit cash. And then on the 18th, you purchased $8,500 of merchandise from Frist Corp with credit terms of 1/10/30 invoice dated on the 18th and its FOB destination. So you would again go ahead and debit purchases 8,500, and then you would go ahead and credit the accounts payable Frist 8,500. That's in a periodic. Again, in a perpetual, rather than using a purchases account, you're going to go ahead and use the merchandise inventory account 8,500, and then same thing, credit Frist. And then on the 21st, after negotiation, you received from Frist a $500 allowance towards the $8,500 that was due on April the 18th. So in order to reduce the amount that's due to Frist, because they've given you a $500 allowance, you're going to debit the accounts payable Frist by $500, and then you'll go ahead and credit the purchase returns and allowances for $500. Now, as periodic and on a perpetual system, what you would do is you would do the same thing. You would debit the accounts payable $500, and then you would credit the merchandise inventory. And then on the 28th, you sent a check to Frist paying off the April 18th purchase, net the allowance and the discount. So you have an accounts payable debit of $8,000 because that clears the amount of the liability. And then you have purchase discounts of $80, and then you are going to pay cash then credit of $79.20. And so then again, that's periodic. And then on a perpetual system, you would have same thing, a debit to accounts payable of $8,000, and then you would have a credit then of $80 to merchandise inventory, and then you would have a credit to cash $79.20. So pretty much the only difference between these two, if you were to look, is that on a periodic system, you're going to have specific accounts for the different activities. But on a periodic system, in a perpetual system, you're going to just do everything in the merchandise inventory account. And that the amount of inventory, what's listed in that account should be how much inventory you have. Now, obviously, you may have to still go back in and physically count your inventory in order to make sure that what the computer says, which is what your books say, are what actually is the inventory that you actually have.